Welcome to 5 Barrel Factors, the channel where we break down the 5 key forces shaping global crude oil prices. During week 43 of 2025, ICE December Brent crude rose by 2.2% week over week, climbing from $62 to $63.40 per barrel. Here are 5 key factors that influenced crude oil prices over the past week. First, EU sanctions target Chinese and Russian energy links. The European Union's 19th sanctions package has targeted 69 entities, including 12 in China and 3 in India, as well as Russian energy majors Rosneft, Gazprom Neft, and Lukoil's Litasco unit. 2 Chinese state-owned refineries, Yulong Petrochemical 400,000 barrels per day and Liaoyang 180,000 barrels per day, were sanctioned for importing Russian crude through the ESPO pipeline. The EU also restricted the trading operations of China Oil, PetroChina's Hong Kong-based arm, marking the first direct EU action against a major Chinese energy trader. These measures, alongside bans on 5 Russian banks and a crypto exchange, signal a widening enforcement effort to curb Moscow's oil revenues. Heightened geopolitical tension and potential supply disruption supported an upward movement in oil prices. Second, India's refiners navigate new sanctions pressure. India's refiners face a sourcing dilemma after US sanctions on Rosneft and Lukoil, announced on October 22. Despite tighter restrictions, India imported 1.75 million barrels per day of Russian crude from January-September 2025, down only 4.6% from 2024's 1.83 million barrels per day. These volumes make Russia India's largest supplier, accounting for roughly 35% of its total crude imports. Industry officials warn that payment channels will close under full enforcement, echoing the total halt seen during sanctions on Iran in 2018. While refiners seek alternative suppliers, the transition will take months, potentially tightening Asia's supply balance. Sanction uncertainty and reduced Russian inflows pushed prices higher. Third, China's state oil firms step back from seaborne Russian crude. China's state oil giants, Sinopec and PetroChina, plan to halt seaborne imports from Rosneft and Lukoil amid US sanctions. The move could cut China's Russian crude intake by 500,000 barrels per day, lowering total imports to 1.99 million barrels per day between January-September, down from 2.16 million barrels per day a year earlier. Pipeline deliveries of 800,000 barrels per day via ESPO and Kazakhstan routes are expected to continue under bilateral agreements. However, independent refiners, known as teapots, remain reliant on Russian cargoes, having imported 25.3 million metric tons in the first 9 months of 2025, up 12.7% year-to-year. Market analysts warn that restricted seaborne supply could widen price differentials and reduce liquidity. Lower seaborne flows from Russia to Asia supported Brent prices through tighter regional supply. Fourth, Trump's trade talk and tariff tension boost market volatility. US President Donald Trump said he may raise tariffs on Chinese imports to 155% unless a fantastic deal is reached by November 1. His remarks followed escalating trade friction that lifted VLCC freight rates and disrupted Asian crude logistics. A 55% tariff already in place has increased costs for US-China oil trade and added volatility to global tanker markets. The cancellation of the Trump-Putin summit and news of expanded sanctions on Russia further fueled uncertainty. Analysts note that stronger rhetoric, alongside potential military escalation in Eastern Europe, spurred risk premiums across energy markets. Trade and geopolitical tensions lifted oil prices as risk premiums widened. Fifth, Norway's output jump adds bearish pressure. According to the Norwegian Offshore Directorate, Norway's crude output surged 10% year-on-year in Q3 2025, averaging 1.92 million barrels per day. Including NGLs, total liquids reached 2.11 million barrels per day. The increase was driven by the startup of the Johan Castberg field in March 210,000 barrels per day and the Balder field revamp in June 80,000 barrels per day. The upcoming Johan Sverdrup results, representing 1/4 of North Sea output, are expected to confirm sustained production strength. Rising European supply contrasts with tightening flows from Russia and Asia, balancing bullish geopolitical drivers. Higher Norwegian output weighed slightly on prices, tempering recent gains. Thank you for watching 5 Barrel Factors. Stay with us for clear, concise insights into the forces driving global energy markets. Don't forget to subscribe and continue following the channel for daily updates.